Thinking about a hedge of my tech-heavy portfolio in front of the NVDA earnings, QQQ or VIX or both. Well, yeah, if you wanted to short something against your long NVIDIA position, you could short the Qs, because if NVIDIA and the Qs go the same way, right? If NVIDIA makes a big move up, the Qs are going to go up. If NVIDIA makes a big move down, the Qs are going to go down. So yeah, you could put on a little bit of a hedge in the Qs. So if you got a bunch of long deltas in NVIDIA, put on a few short deltas in the Qs just to make your NVIDIA position smaller. Or you could completely eliminate some of the deltas depending on how you play it. That way you really don't care how NVIDIA moves on earnings, because you're essentially going to break even either way between the two trades. He says, I'm trying Thinkorswim's paper trading. Doesn't hurt to practice. Yeah. When the TASTYTRADE guys, when they originally created Thinkorswim, and then they sold Thinkorswim to TD Ameritrade, created TASTYTRADE. They didn't create a paper trading feature in TASTYTRADE. People always ask about it, and I think those guys now they don't really like the idea of paper trading. They don't think it's good practice, which I can kind of understand. As somebody that's played a little bit with paper trading, when I was first starting to trade as well, it is very different when you are trading with fake money, because mentally it's hard to treat it the same way. You really don't. You don't go through that whole emotional roller coaster like when you have big wins or big losers with paper trading, because it's not real trading. Well, that's the only downside to paper trading, is it's just not the same. Kind of like, I don't know, playing poker with fake money, right? You can play poker with fake money, but really you don't know how to play poker until you actually have some skin in the game, right? Tesla, yeah, opened up about $20, but quickly sold off a few dollars here. Now it's only up $16.60. Let's see what my put credit spread is being priced at now. So this thing came back nicely. Yeah, $40 winner, just basically on today's move. And I actually put this thing on, you see, 3 days ago. So I put that on Friday. Basically, Tesla opened and it started going higher. I want to say Tesla was up about $6 at the point I put on the spread. So it was somewhere in the lower part of this candle. So I got the rest of the day plus the big gap up today. So I was kind of lucky on the timing of that put credit spread. Because if you guys were around last week, I had mentioned, like, every single day, I was like, man, I really want to put a bullish trade on in Tesla, but I need it to come down. Well, I got 1, 2, 3 red candles, and then the next day it opened slightly lower, but you could tell it was starting to go higher. It was starting to go higher quickly. So I quickly jumped in on a put credit spread, and it looks like that might work out. We'll let the pricing settle down. Tesla, though, up $19. See the 1 minute chart here. Candles since the open here, these big candles here. A little bit of a fight between buyers and sellers. Of course, with a big gap up like that, you're going to have some people wanting to take profits. So you're going to have the bulls and the bears fight it out a little bit in Tesla. But Tesla, with a move like that, Tesla's what's keeping the NASDAQ afloat today. Still up, though, up on the day, up 50. Tesla now is up $24. That is insane. I'm going to go ahead and take my put credit spread off for a winner if they'll let me. I'm going to put in a closing price of $52. Now that's only a 33% winner, so I sold it for $150 premium. It's only a 1/3 of that instead of 1/2 of it. But I've only been in the trade essentially one day. I put it on Friday to take it off on Monday. Like, if I can get a 35% winner in a day, I'll gladly take it. I can always get back in Tesla, put on another trade at another time. Sometimes I get the question of, when to take profits. Obviously, 50% winners, kind of like a standard rule. But I also have to think how much time I want to spend in a trade. Like, that was a 60-day put credit spread. If you're going to give me 30 or 35% of max profit in one day out of the 60 days, I'm going to take it. Why stay in the trade to make that 50% target if, for example, I might end up in the trade another week, another 2 weeks, another 3 weeks, right? If you can make that quick profit, anytime I make 25% or more in one day, that's such a quick win. Just take that money and go. Because in the long run, you make more money when you take those quick winners like that. Because if you can take 25, 30, 35% in a day, well, then you can take that capital, immediately put it into another trade, and keep that money working for you instead of having things tied up in a longer trade, trying to squeeze out an extra few dollars. ARKK. Now this is one I've been fighting for a little while. I had a strangle that was going against me in a big way. Then I eventually rolled it and rolled it some more. It kept going badly against me. It kept going up. It eventually got to the point where I was so scared of it keeping going up and eventually threatening the call side of this strangle that I bought 100 shares, essentially turning that call into a covered call, so I no longer had to worry about ARKK going up. Of course, as soon as I did that, ARKK started going back down. It stopped going up and started coming back down. So then I started losing money, obviously, on the shares. So then I doubled up on the call side, just trying to keep a balance of deltas here. But it's worked out all right. Overall, I'm down $500 on the whole position. But most of that is the shares, and the shares down $374. I'm less concerned about the shares, because if I hold on to the shares long enough, it'll come back to the price I got in at the shares, because shares are not like options. You can hold them for as long as you want. It's not a very high price stock either. So it was mainly the strangle that I was worried about this here. And I've eventually whittled away at this to where it's only a $138 loser, where it was a much bigger loser at one point. Plus now I have the extra call on as well. So if it goes down, which it has been going down here in the last few days, although today it's up slightly. But that extra call is helping me a little bit too. Eventually, I just want to get out of all of these options, or essentially break even. If I can do that, I'll be done with the trade. Then I'll hold the shares until I can get out of them for break even. I just want to break even on the trade at this point. I'm not trying to win. Yeah, the expected move with NVIDIA earnings is plus or minus 8%. Is that reliable? That's what the move is. Now, is that guaranteed to happen? No, there's no guarantees. What that calculation is they calculate that is going to be the move 68% of the time. That's how that works. I do want to cover this expected move thing, because this is important. If you don't know how this works, let me go back to NVIDIA. I don't have an NVIDIA position. Type NVIDIA. Let's go to the options chain. So the 4-day cycle, the expected move is plus or minus $12. So if you want a visualization of what that move is, it is this brown ruler here on the options chain in Tasty. That is the expected move for the next 4 days. Obviously, most of that move is the earnings on Wednesday. So you can essentially say earnings, the move is plus or minus $12, right? Up or down. Now, is that reliable, you say? When you say reliable, yes, it's reliable, as that's going to happen most of the time. Is it 100%? No, nothing's ever 100%. There's nothing in trading that's ever 100% guaranteed. What this is 68%. It's essentially your bell curve. This is the bell curve. This is the 68% area. 68% of the time, NVIDIA's price will fall in this area over the next 4 days. 32% of the time, NVIDIA's price will go outside of that area. So basically, 2 out of every 3 times it's going to finish in this area. 1 out of 3 times it's going to finish outside this area. That's how you think about the expected move. And that's kind of how I think about earnings, knowing that plus or minus 12 on the 4-day cycle. Let's imagine I want to play this with an iron condor, but for an iron condor, I'll add some time to it. I'll go to a 32-day cycle. But I know, the earnings event this week, it's really planning for like a $12 move. Well, if I go do a iron condor, my typical iron condor, probably somewhere around, let's go to the 15 delta here. Yeah, that's fine. Let's go to around 19 deltas on this side. Yeah, that'd be fine too. So this is a standard kind of iron condor that I would put on just as a normal trade, even without earnings. But knowing earnings is coming up, would I be fine with this iron condor, knowing NVIDIA they're pricing that expected move to be about plus or minus $12? Well, I am $21 out of the money on the put side and $25 out of the money on the call side. So knowing the expected move for the earnings event, it gives you a pretty good indication of whether you're safe on some of the trades you may be thinking about putting on, or even, if you're bullish. Maybe I want to go sell a 60-day short put. Typically, I'll go out here to the 15 delta, which is the 115 strike. Is that safe? Well, if NVIDIA is likely to make a $12 move this week, let's imagine it's the $12 move down. Is my 115 put an okay trade? Is that safe? Yeah, probably, because if I get a $12 move down, that's only a move down to 124. Well, I'm still $9 out of the money at that point. But I mean, I could go even further if I thought, it's still too close. I can go sell a 10 delta put. Now, is that safe? Probably. I mean, that's $30 out of the money. NVIDIA is only supposed to make a $12 move, 68% of the time. So, yeah, that's how you use that expected move, as far as, it gives you a pretty good indication of where things are likely to end up. And hopefully it gives you an idea as far as you're able to make better informed decisions on, where you're putting on some of those trades.